It's important to always understand items are always assessed as a set. That means a set of chairs are calculated as a group. Hey guys, Tuan, Director of Dura Tax here. Today we'll be looking at the top 5 depreciable assets you can claim in your living room. We'll be talking about the approximate costs of these assets, as well as the effective life of each. A length of period in which the ATO recognises these items will last, and it ultimately determines how fast the items will depreciate. Of course, the shorter the effective life, the better the depreciation. Number 5, floor coverings. Most often found in living spaces will be carpets similar to this, which has an effective life of 8 years and can be purchased from $35 a square metre. Carpets are generally the middle pick when it comes to depreciable value when compared against other types of flooring, which may be vinyl flooring and floating timber floors. Besides its insulating benefits, it also has the shortest effective life provided from the ATO and hence will depreciate faster than any other type of floor covering. Number 4, fireplace, or referred to as central heating units. These have an effective life of 20 years and can be purchased and installed for around $5,000, which is a relatively high value, which gives you much higher depreciation than some of the other type of heating units. Number 3, light fittings that are replaceable have an effective life of 5 years and will be valued throughout a house at approximately $3,000. Number 2, air conditioning units that are split system up to 20 kilowatts of power are depreciable over 10 years and are valued at $2,500, or ducted air conditioning systems which are 15 years in effective life with a value of $8,000. And number 1, blinds. Traditional electric shutters have the same effective life, however we get more value to claim depreciation out of a higher cost asset, which means the electrical system is better. On the other hand, a lower cost asset, which is one that costs less than $1,000, will be able to get into a low value pool, which means that they aggressively depreciate, like a set of blinds for example. Assets costing less than $1,000 depreciate at almost 19% in the first year alone and 40% in the consecutive years after that. It's important to always understand items are always assessed as a set. That means a set of chairs are calculated as a group. Take for example the dining chairs. As the ATO recognises that with a bit of common sense, an investor or homeowner would purchase these as a set. As such, would be valued by a quantity surveyor as a set and not individual chairs, which we then are not eligible for low value pooling unless the set itself is valued below $1,000 collectively. So these form the 5 most depreciable assets in your living room. These are the things we look for when we assess a rental property for depreciable assets. If you want to know more about what you can and can't claim for your living room or property in general, visit us at duratax.com.au for a quote. Thanks for watching. See you next time.